If you've ever applied for a loan or even a credit card, you may have heard the term debt-to-income ratio. And even if you haven't heard of it, banks and lenders are still calculating it when you apply for a credit card or a loan. Hey everyone, this is Cody with Rent Reporters, and we'll go over what the debt-to-income ratio is, how to calculate it, what a good debt-to-income ratio looks like, and one really important thing that you need to watch out for when using your debt-to-income ratio. And we'll do all of that right after you like and subscribe to our channel. First off, what is your debt-to-income ratio? There's actually two different types of debt-to-income ratios, or DTI, because that's just easier to say, but we'll go over the differences in just a minute. Now, DTI is pretty much exactly what it sounds like. It's the ratio of your debt compared to your income. And this is looked at the monthly level. So if you have $100,000 in debt, but you only have to pay $10 per month, well, then congratulations, you got a great deal. And even though you have $100,000 in debt, your DTI is only impacted by $10. To calculate your DTI, simply add up all of your debt obligations for the month and then divide by your total gross income for the month, which is your total income before taxes are deducted. Then just multiply that by 100 to get the percentage. The lower the number, the better, because you have a higher ratio of income compared to debt. If your ratio is high, lenders won't lend you money because they may think you won't be able to pay back your debt. For example, let's say your gross income is $3,500. You pay $1,200 in rent, $200 on your car payment, $200 on student loans, and you have no credit card debt. Your DTI in this case would be 45.7%. You have $1,600 in monthly debt obligations divided by $3,500 in gross pay. But what if you have some credit card debt? Now, using the same example, let's say you have $5,000 in credit card debt. Your credit card debt's impact on your DTI is only the minimum payment, not the total. So if your minimum payment for $5,000 in debt is $125 per month, your new DTI is now 49.2%. Now that we know how to calculate your DTI, what is a good DTI to aim for? Well, it depends what you want to do. Generally speaking, a DTI of less than 36% is considered good. If you're applying for a credit card or a car loan, you don't want to be any higher than 43%. Once you go beyond that, you're likely to have trouble paying your bills, and we'll go over that in just a minute. If you're looking to buy a house, the numbers are calculated a little bit differently. Remember how I said there's two types of DTI? You have a front-end DTI and a back-end DTI. The front-end DTI only takes into account the mortgage payment compared to your income. The back-end DTI is what we talked about earlier and takes into account all other debt obligations, with an exception that we'll come back to. When applying for a mortgage, your front-end DTI needs to be less than 31% if going through an FHA-insured loan. This means even if you have zero other debt obligations, no car payments, no student loans, if the mortgage is more than 31% of your gross pay, you likely won't be approved for the loan. For non-FHA insured loans, the front-end DTI max drops down to just 28%. And if you're good on the front-end DTI, you still need to be below 43% on the back end to get approved for mortgages through most lenders. Alright, so remember when I said there's an exception to your DTI? Well, your DTI is a really good baseline to see how healthy your debt loads are compared to your income, but there's some really important things that are not included on your DTI. And that would be your health, auto, and any other insurances that you might have. And it also doesn't take into account things like your Netflix subscription, your food expenses, which are slightly more important than Netflix, your gas and your other transportation costs or other utilities. It's also calculated before taxes are taken out of your paycheck. So using our earlier example, if your DTI is 45.7%, you're probably doing okay being able to pay for everything. You're probably not stressing too bad, but you might not be saving as much money as you'd like to. Now, if you're up to 49%, you're probably feeling that a lot more. You might have to work to make your budget last you from paycheck to paycheck. And that's why it's so important to keep your debt obligations, meaning the money that you have to pay back to creditors, under control and as low as possible. You can always skip Netflix for a month or cook at home a couple extra nights a week instead of going out if you're tight on money. But you can't skip paying your rent, car payment, mortgage, credit card, or student loans without risking defaulting on your loan and facing serious consequences. Well, that's it for this video, everyone. Again, don't forget to like and subscribe for more tips like these every week. This is Cody with Rent Reporters, and I will see you in our next video.